In the last video, we saw the introduction of a two-asset portfolio and investigated this in terms of leverage. In this segment, we'll expand on our previous discussion, exploring various scenarios including those with uncorrelated, positively correlated, and negatively correlated products where none are risk-free. We'll start with uncorrelated assets, this time with both carrying risk. For this, consider two products with identical expected values and standard deviations. This can be a scenario typical for various low correlation stocks. Reflect on the expected value and standard deviation of this portfolio composed of these assets. How do you think these metrics change with different allocations, and how should you distribute your resources? So, the portfolio's expected value is the weighted average of the two assets' expected values. Since both our securities have an equal expected value, this also remains constant regardless of their allocation for our portfolio. For the standard deviation sigma p, let's now break down a formula. With the correlation ρ equaling 0, the covariance term is eliminated. Since sigma 2 equals sigma 1, we can also factor out sigma 1. What's left now is sigma 1 multiplied by a function of w1. Graphing this relationship, we observe it's always less than 1, except in the extremes, where the portfolio is fully invested in one stock. At the midpoint, where we have an equal weight, the portfolio volatility is minimized at a value of 1 divided by the square root of 2. This trend is also evident by the plotted line connecting S1 and S2. Let's try to put this into context using some real-world example. An illustrative example for this would be two largely uncorrelated stocks like Boeing and McDonald's. Here a 50-50 allocation is the most sensible since it minimizes variance while maintaining the expected return. This is also why diversification is very powerful. We do not give up any expected value but are still able to reduce our variance. So averaging two individual assets is better than holding only one of them. The scenarios discussed in the last video and so far are a bit idealistic. Typically, the challenge lies in choosing between products with varying risks and rewards. So let's examine two products where neither are risk-free, but S2 has a higher variance and a higher expected value than S1. So consider the impact that these assumptions have on mu p, sigma p, and how they change for different weightings of our two-asset portfolio. Is diversifying still a beneficial strategy? When thinking about this, don't get discouraged if nothing cancels out when you write down the formula. Try to think more intuitively about this and what this example represents. When writing down the formula, we notice that nothing except for the covariance term can be cancelled out. Both the mu p and sigma p depend on the weighting w1. Further, when plotting mu p against sigma p, it becomes apparent that the diversification reduces risk but may also decrease the expected return. So notably, the portfolio with equal weights is not the one with the lowest risk. To minimize variance, a smaller weight should be allocated to S2 due to its higher variance. Intriguingly, mixing a lower variance asset S1 with a slightly higher variance asset S2, we can reduce the overall portfolio's variance, provided that they're not highly correlated. An example scenario for this could involve combining a higher yield non-risk-free corporate bond S1 with a stock S2. The rational allocation here depends on your risk tolerance. Note that here only the upper line of the plot is relevant when making decisions based on expected value and variance, as it represents the most efficient use of capital given the risk-return trade-off. To minimize the variance of the portfolio, weigh the stock with high variance a bit lower. So now, let's explore a scenario where two products are perfectly positively correlated. While perfect correlation can occur with different standard deviations, for simplicity, let's consider both products having identical expected values and standard deviations. In that case, what impact does weighting have on the portfolio in this context? What approach should we take to minimize variance? Once again, the expected value μp mirrors the individual mu's. For the standard deviation, we consider the perfect correlation where ρ equals 1. Since ρ equals 1, we do not need to consider it here, since it doesn't affect the multiplication or the sum within the square root. To simplify this expression, we apply the binomial theorem in reverse to arrive at this simplified expression, where we just sum up the weighted standard deviation of the two products. Since we're taking the square root of a squared sum, this clearly simplifies to the same expression without the square root or square. That means we now have W1 times the standard deviation of the first product plus W2 times the standard deviation of the second product. Next up, we replace W2 by 1 minus W1, since they both need to add up to 1. This results in sigma 1. So let's think about what this actually means and whether this outcome makes any sense. This calculation reveals that diversification has no impact on this scenario where the products are identical and perfectly correlated. So for instance, constructing a portfolio with Boeing and Airbus where both behave almost identically results in a portfolio similar to just holding one of them. So to mitigate risk, a high positive correlation poses a significant challenge. Many financial assets, particularly stocks, tend to show a positive correlation. They actually often move in the same direction, driven by overarching market sentiments. So, if positive correlation hinders diversification, what does negative correlation look like? Let's explore the same scenario with the opposite ρ value of -1. Consider the formulas and price movements. If S1 increases, what happens to S2? What's the impact of diversification in this case? The expected value once again remains unchanged. Now, for sigma p, we'll adapt our previous calculations to accommodate the ρ equaling -1. Let's again use the binomial theorem in reverse to simplify the first expression. Note that this time we use a minus b squared since ρ is -1. Next up, we rewrite the square root of the inner squared expression in terms of its absolute value, since we know that this can never be negative due to the squaring anyways. Next, we again replace W2 with 1 minus W1 to get the expression of W1 times sigma 1 minus W1 times sigma 2. We can now further simplify this by using the fact that sigma 1 equals sigma 2, which gives us a final expression of sigma 1 times the absolute value of 2 times W1 minus 1. So let's verify this outcome. If W1 equals 1, we indeed get sigma 1 aligning with S1. Setting W1 to 0 results in the absolute value of -1, yielding sigma 1 again, which is equal to the standard deviation sigma 2 of stock 2. At W1 equals 1/2, the result is 0. So this actually demonstrates that with a perfect negative correlation, diversification can completely eliminate portfolio variance at a certain allocation. This phenomenon is also illustrated in the plot. As we adjust W1 from 1 towards 0, we initially reduce the variance, reaching a risk-free portfolio with equal weighting at the gray dot, before progressing towards S2. An illustrative example of this would be two stocks that are very negatively correlated, such as for example Boeing and Zoom. When one increases, the other one decreases by a comparable amount. Consequently, the overall portfolio change is null. However, these stocks might still both exhibit some positive drift, which will lead to a positive expected value μp, while still bringing sigma p to 0. So this showcases that diversification is highly effective with negative correlations, and in scenarios of perfect negative correlation, it's possible to achieve zero variance. This raises the question, does this work in the general case as well? Consider the scenario where μ1 is less than μ2 and sigma 1 is less than sigma 2 with a correlation of -1. For such a setup, can we still achieve an allocation of the two stocks with an aggregated variance of 0? When thinking about this, try to think about this intuitively without formally calculating things. So the answer is that it can in fact be shown that diversification can still be used to achieve a portfolio variance of 0. This optimal weight of the two stocks at which this is achieved is influenced by the ratio between sigma 1 and sigma 2. To better understand this, consider this plot. As always, the grey dot at the center of the path from S1 to S2 represents a 50-50 split of the two stocks. Since this grey dot is positioned on the upper half of the path, we can see that we need a greater allocation into S1 in order to achieve the minimal variance of 0. This also kind of makes intuitive sense, since to cancel out the movement in volatility, we have to allocate more of our portfolio weight to the less volatile asset. So this scenario could apply to stocks like Boeing and Zoom if they demonstrate different expected values and volatilities, but yet they maintain a perfect negative correlation. Depending on your risk tolerance, variance combinations are viable. With a perfect negative correlation, achieving a risk-free return is feasible. While these extreme examples are illustrative and they allow us to build intuition, an obvious question is, how do these concepts translate to real-world markets and actual financial products? Well, in reality, when correlations are not perfect, such as -1, 0 or 1, the effects observed in our examples still apply, although in a diluted form. Diversification typically lowers variance and averages out the expected returns. The way you allocate your investments and trades should align with your risk preferences and objectives. So what are the key points to remember about diversification? First of all, diversification is a strategy that generally reduces risk and balances expected returns. It is most effective when the assets involved are uncorrelated or even negatively correlated. Even including riskier assets in a portfolio can reduce overall variance, provided that these assets are not strongly correlated with the rest. Diversification is often referred to as the only free lunch in finance, since it allows for risk reduction without a proportional decrease in expected returns. Furthermore, one can also diversify over time if one has a long enough time horizon to average out variance. That said, there are a lot of simplifying assumptions embedded in these models that might not always hold in real-world situations. Nonetheless, the main takeaways can be used to build intuition and get a better understanding of the general concepts.